So I think eventually we are a country of savers. We are trying to become a country of investors. And in fact, the last part of India growth is going to be how well we convert our savings to investment. If you have to choose between inflation and recession, I always believe that we should choose global recession rather than global inflation, because global inflation has a lot of other issues with India. When I heard the amount that they're allocating for investment for capex, I think it was a very heartening amount, because I do think that the private capex, and we can talk about it in a little bit, that the private capex in India will take another 1 year to start. So I think government needs to keep up the investment uh, pace that has been there. Last almost 3 years, it's been mainly the government capex which has been driving the investment part of the economy, and government will need to do that for 1 more year. So one is, I'm happy that they've allocated the money. Basically, they've increased allocation to capex and reduce it from some of the subsidy and the welfare programs. So I think in the long term, also it's a good thing, but in the short term, it is very, very helpful. As I was earlier saying, I think the government's ability to spend this, a 10.5 lakh crore is a very good thing. Having the right projects and execution of this is very, very critical. And I think we'll know by the first half how the pace of this execution is going, because I think yeah, the amount is available. Now we have to make sure we convert into investments in roads and railways and all. And I think in a way it's a smart thing they have done, because they have curtailed the amounts to the welfare programs and the subsidies, and they can always, I think, scale it back in the next year, which is also going to be election year. So in a way, I think it is a very nice calibration that they have done. I think I've seen the stock market and the economy are very, very correlated in the long term. So if you look at the returns in the market over the last 30 years and the corporate earnings growth rate, they are both almost 14-15%. So the market has given about 15% return. The corporate earnings have also grown at 14-15, and the same is true with any company also. I think usually your earnings are highly correlated, your stock price is highly correlated with your earnings growth in the long term. In the short term, there is a lot of other drama and psychology and everything gets added to that, which is also what makes, I think, stock markets exciting. And we have, news and channels which give you, ball by ball commentary on that, because the stock market also has that other element that it is alive all through the day. And there is a ball by ball commentary happening. I think one of the things I've seen is there are always phases of expansion and then phases of consolidation. So like, as you said, even what happened with Edelweiss, we grew very sharply between 2011-12 to 2018. And as we had grown, I think the earnings were kicking in, the business cycle was positive. Then 2018, I think the earnings and the growth came under threat for all NBFCs and credit. It happened to banks earlier, it happened to NBFCs after 18. Along with that, I think there was a need to deleverage. And I think I'll come back to this phase, because I think deleveraging from time to time is very important for every corporate to become stronger. So because when you grow, you keep on adding leverage and the earnings are there. But once the earnings become slightly much under pressure or earnings slow down, like our earnings have come down over the last 3-4 years. And as I said, I think when earnings come down, you have to become more efficient in your capital, in the borrowings that you have, all of that. You have to raise equity, you have to raise debt if you want to grow. If you have to grow, you have to keep on raising equity, raising debt. I think there are times to raise equity, there are times to raise debt, and every company has to balance it very well. But when you try to balance it, you go a little bit out of balance. And I think that is what has happened. Now, the answers are usually very clear. Every corporation in India which has come under this, what is called, you are over leveraged, the answer has been either slow down growth and or raise equity. I would say what they've done is very smart, and I actually wholeheartedly endorse that. And I'll tell you three, four reasons I think it is better. One is they have not tried to force anybody. They've given both the option, the old regime and the new regime. The old regime has, all the deductions and everything. The new regime is a clean one. Ideally, I think all of us have been saying that rather than have these complications of deductions and keeping tabs and all that, it's just easier to have very simple slab rates and just pay the tax. So I think that getting people to move from old to new, without just and without just forcing them to move to new immediately. I think in the next couple of years, almost everybody would have moved to the new one. The second part is a lot of these insurance changes and all that. I mean, if you until you are earning about 15 lakhs or 20 lakhs or 25 lakhs, I think maybe if you're investing a lot in all these deduction oriented schemes, maybe the old regime is still better than the new regime. But somewhere between 15 lakhs annual salary to 25 lakhs annual salary, I think moving to the new one is a lot better because you are the maximum surcharge has also been dropped. And the third thing, I think people save for various reasons. This arbitrage between various instruments of saving is just unnecessary complication, because also remember, half the household savings or half the financial savings of households in India, they go into bank deposits. They don't have any income tax advantages. There is no ATC and all that. I mean, there are some schemes, but overall, people do save and keep their money in banks, without waiting for any income tax incentives for that to kick in. So I think eventually we are a country of savers. We are trying to become a country of investors. And in fact, the large part of India growth is going to be how well we convert our savings to investment. At currently 30% savings rate at a $3.6 trillion economy, our savings is $1.2 trillion, which is a lot more than what any foreigner will invest in India in any year. I think if you look at after COVID, the lower end of the segment, the rural India and the poorer people, their balance sheets, their financial reserves really got stretched and impacted, because obviously jobs and everything else got impacted as a result of that. So I think the urban part of India managed COVID well, and but the lower part of India, the upper half versus the lower half has got impacted by COVID. The household sector has got impacted. The poorer people have got impacted. So I think that will continue to be an area which will have to watch. And I think the only answer to that is growth. But also, I think every time there is a global recession, it has in a perverse way been good for India. So we are all hoping. I mean, if you have only two outcomes, let us say extremely, either inflation, global inflation, or global recession, because in order to kill inflation, the US Fed will usher in a recession in that sense. If you have to choose between inflation and recession, I always believe that we should choose global recession rather than global inflation, because global inflation has a lot of other issues with India. Oil price goes up, cost of capital goes up, interest rates go up, and we import oil and capital. So the cost of both of them go up. When there's a global recession, it does shave off some part of our growth, because some part of our growth comes from global growth. But perversely, oil prices come down, capital cost comes down, interest rates come down. So historically, India has done well when there is a short-lived global recession. And I'm hoping this year we might see that.